Hi, my name is Richard Rousseau, and in this video clip I'm going to prove to you without a shadow of a doubt that Forex is completely and utterly random. This revelation came to me about 3 months ago, in end of 2014, and I finally managed to make this video clip now in 2015. Just to give you a little bit of background on myself, I'm a programmer, but also on the sideline had an internet cafe, and in this internet cafe the Forex traders actually joined the cafe to do their Forex trading, and that's how I was introduced to Forex about 9 years ago. So as a programmer, I've liked the MetaTrader platform. I've been programming in it. I've programmed hundreds of strategies. I've written my own indicators, and I've also written a lot of robots. So please note that everything in here is my own opinion, and as I said, you won't find any clip like this anywhere on the internet. I've been searching for Forex and randomness, but I haven't found anything like this, and I hope through this video clip I could actually at the end of the day save you a lot of money, maybe open your mind a little bit, reveal some amazing stuff to you, and at the end of the day prove to you also that Forex is completely random. I would just like to quickly go over the content of this clip so that we're not wasting each other's time here. So yes, I'm going to spend 10 minutes and show you why people believe that the Forex is not random. And then I'm going to spend 2 minutes on my punchline. So basically I would say the first 15 minutes of this video is the most important, and I'm going to show you an amazing punchline, but you need to watch the whole first 15 minutes at least. Then we're going to go to Excel, and I'm going to show you how to build your own Forex model, or maybe prove to yourself what I've just shown you, but I don't want to spoil it now. Then I'm going to spend 30 minutes on disproving common indicators. For instance, support and resistance, trend lines, MACD, divergence, sweet spots, which basically are zero lines, the Fibonacci, moving averages, and candle patterns. And I hope you understand that if I can disprove these ones, it basically means that any indicator that you could be using, the same principles apply. I mean, most indicators is basically something to do with moving averages, so that will basically disprove it doesn't matter what indicator you are using, the same principles will apply. Then I'm going to prove to you that Forex is nothing more than the flipping of a coin, and I'm going to spend about 2 minutes on that. Next, I'm going to prove to you that trading Forex and maybe trading pictures of mountain silhouettes is exactly the same thing. There's no difference. Then I'm going to give my opinion on why I believe Forex is random, why it turned out to be random. And then I'm going to answer the big question: how about people that can show you positive accounts and graphs and say, well, look at our accounts, look how well we're doing, so how can Forex be random? So I want to give my opinion on that. I'm going to talk 2 minutes about binary options, and then I'm going to talk about Warren Buffett and a statement that I read about him that he made, and very interesting. I'm going to talk a little bit about optimization of trading robots and how you can be deceived by them. I'm going to make my final end statement, and then lastly I'm going to talk a little bit about Forex statistics. And at the end of the day, I would like people to post back to this clip. Maybe say yes, they agree or they disagree. Maybe I'm looking for people that's working in Forex companies to maybe give us the real statistics of how many people are actually making it in Forex. The common theory out there is that 10% are making it and 90% not, but I believe that statistics is completely skew. I won't be surprised if it's like 1% or 0.1% or 0.01%. So I hope you enjoy this clip, and I hope it can be a revelation to you as it has been to me. 5 to 10 minutes to just go through some principles why people believe that the Forex market isn't random. So in lesson 101 about Forex, I was told that the Forex move in waves, so you'll get an up movement and a retracement and an up and a retracement, and at some point it will break the previous low here, so you'll get this down movement and a retracement down retracement, down retracement, and down again. So it does seem like the Forex market does move in wave patterns. I'm just going to add a few indicators that a lot of people use. I'm going to start with a simple trend line. Normally you connect a low point with a low point, so I'm going to connect those 2 points, maybe like that. And it once you connect it, it does seem like the market tried to break the trend line. It was a failed attempt, and the people are saying this should the market now went up because of that. It tried almost here again, but eventually this is a typical move where you get a candle breaking the trend line. It goes down, and then this trend line used to be support this market for up. At this moment in time here, it becomes a resistance line. So this up here, it was resisted by this line, or you could say this line is giving a support for this for the market to go down here. So I'm just going to draw another trend line in this down move here. So I'm connecting those 2 points, and you can see the market is now in a down move. So those are trend lines. Another indicator that a lot of people use is the I call it parallel lines. I'm just going to delete this one, and it's just a little bit of advancement of a trend line, or maybe just a channel. So yes, let's connect those 2 points again, but this time I'm going to take this point here and connect it to that high of that candle here. And as you can clearly see, the market seemed to move within a channel. So it went up almost to the channel, back to the channel, up to the channel, back to the channel, up to the channel, and finally it broke the channel, which was the same line as my trend line that I drew earlier. So these channels are formed on all the time frames, and very interesting. A lot of times you get channels within channels. So I'm quickly going to go to the daily and maybe just draw a channel here. Maybe like that. If we go back, you'll see there's a channel down within a channel, and obviously there's most likely a channel here as well. Don't know if it's exact, but the point is that you get channels, and on smaller time frames you get channels within in channels. It does exactly as in the bigger time frame. Next, I would quickly like to talk about support and resistance. It's normally horizontal lines, so I'm going to draw a line here. Some people draw lines at the low or the highs of candles, but some people believe that you should look at the line chart and draw it there. In this case, I just draw it here because it looked like this low here. Those 2 candles are the same low, and it seems like the line was perfectly supported here in the future. So people are saying yes, you can draw support and resistance lines, and those lines will be retested in the future. So maybe I can draw another line. I shown earlier this one here, where those highs there were tested there. Another typical support and resistance or lines are maybe previous lows and previous highs. That gets tested again. It's just another form of support and resistance. So it does look like the market retested this low here. So if you draw a line there, it retested it, and so it doesn't seem random. I would also quickly like to add the Fibonacci line. I'm just going to Fibonacci lines from add it from that bottom to there. So as the market formed this down move and it went up here, at this time here you can draw the Fibonacci. And if you look at the Fibonacci line, it just seems like the market retested this. This is the 161.8 line, and if you look at it, they normally say once a Fibonacci line is broken, that the market will typically go to the next line. And there's a lot of candles that hits against the 161.8 Fibonacci line here. And look at this typical move here. A Fibonacci line gets broken, it went down, it actually retested the line, and yes. and then went down, and even here it comes and it retests the Fibonacci line. So people working with Fibonacci lines are saying that the market doesn't seem random. The market corresponds and reacts to Fibonacci lines. And then a lot of people, obviously, at each of the retracements, they look at the Fibonacci retracements. I mean, this is about a 50% retracement level, which is normally, if you get such a retracement, there's normally a strong move coming from such a retracement. So I'm quickly going to add an indicator that's one of the most used ones is the MACD. I took its default values, and the MACD is mostly used for divergence. So what you do, you take a top and a top, and you connect it like that with a line, and then you go to the same place at the market, and maybe you connect that top with that top there, and then can be seen here on the MACD. The MACD is moving down where the market is still moving up. So this is a typical divergence, and people are saying this is a good indication that the market has maybe reached its limit, and that a break of the trend or a reversal in the trend is most likely. And as can be seen in this case, it seems like the market reacted it, and a lot of people would say because of this, that's why the market actually started turning here, and it had a failed attempt there for the top, and then this down move started, because a lot of people draw the same things on a MACD. They saw this, so they basically knew that the market is over. And all of this doesn't seem random. It all seems like a human intervention. It seems like you can actually trade the Forex market according to trend lines and the Fibonacci and support and resistance, double bottoms and things like that. Lastly, I'm quickly going to talk about reading bars. I'm just going to show you one or two pictures. This is an example of a dark cloud cover. This is a bearish engulfing candle. This one is engulfing that one completely, and this is an outside bar. There's a lot of reading bars, but these are just a few common ones. So basically, as I say, you can go read up on them. A lot of traders are using them. I mean, a 3-bar reversal is probably one of the strongest ones. So most people will say that if you look at a down move, there's normally a reading bar that started the down move. So I mean, I know this is also a reading bar that started this up move here. This will probably be some reading bar, but that's definitely a reading bar. So I'm not. You can go read up on that, but I just want to mention reading bars are very strong indicators that a lot of people live by, and they say there's nothing random about reading bars. As I say, mostly before and or at the start of a trend, you will most likely find a reading bars, and that doesn't seem to be random at all. Yes, I forgot to mention sweet spots. I got this sweet spot indicator that you can put on, and basically it shows psychological lines. Maybe if you go here to the 4 hours, you'll see it best. I'm just going to zoom out here. As you can see, it's psychological because the human normally plays to those lines. It's all the round numbers, so it's just like 1.300, 1.31, 1.32, and you know all the zeros for instance here on 4 hours. You can set the sweet spots to go 50, 25, or 100, or however pips you want to go. But basically, sweet spots are lines that ends with round numbers. So let's quickly look here at the 4 hours at the Forex market. You will find, I'm just going to zoom a little bit out, you will find that mostly the market, it goes from sweet spot back to sweet spot. And not always perfect, but it seems to run in ranges from zeros to zeros, and that doesn't seem random. That seems like a human intervention. As you can see here, it broke the sweet spot here. It sort of went up, went back. It's not always perfect, but you will find so many places where it goes exactly to sweet spot, back to sweet spot, back to sweet spot. You know, it seems to test the sweet spot a lot of places here. It seems the sweet spot forms some type of resistance, and then finally it broke it, and now it's support for up move. And you know, it But sweet spot are nothing more than maybe proof, or people will use for proof or support and resistance. So it seems pretty clear that the market does run within these sweet spots. So yet again, people will say there's nothing random about the forex market. It can be predicted, and it seems to form patterns that are driven by human nature, and not just random candles. I just went back to this picture like it was before. So by now you must be saying, well, I've just proven without a shadow of a doubt that Forex isn't random, and that it can be traded, and that you can look at the past and do some future prediction from it. But like any movie has a punchline, whatever my punchline is, that these candles that you are looking here are completely and utterly random. They are randomly generated candles that I've done in Excel through Excel's randomizer. To tell you the truth, I didn't create these weekly candles. I actually created 1 minute candles, and you can see these candles 1 minute now doesn't look typical like Forex. I created over 1 million 1 minute candles and in Excel, and I will quickly show you just now how I did it. Then I imported in MetaTrader, and I converted the 1 minute candles to all these other time frames. That, as I say, if you look closely, they look exactly like Forex. No one can tell the difference between random candles and real candles till I finally came to this. So a lot of people ask me what do I mean by randomness. Well, let's start with a 1 minute candle. Basically means each candle was formed in Excel, and the Excel randomizer decided if the next candle is going to be green or red, and also the length of the next candle. Obviously I had to build in features like the next candle will start where the previous one ends, else it's not Forex. So that's one limitation that has to be built in. And obviously I looked at what is the average move. I look at real Forex data, what is the average move of a 1 minute candle, and I found it's like between 1 and 2 pips. So yes, I put my randomizer within limits when it generates the candles. So so even here on these Excel generated 1 minute candles, if you zoom a bit out, you can already see completely Forex patterns. And once you go to higher time frames, no one is going to be able to distinguish random candles between Forex candles. So I'm just going to show you very briefly how I did it. In MetaTrader you go to Tools, History Center, and basically I went to this one minute here. I had almost 3 years of 1 minute candles in my platform. I exported it to a CSV file, and then basically after I exported it to Excel, I went and you select everything, and you basically delete it. So you clear up all your history so that your Forex is completely empty. I then also disconnected from the internet so it doesn't re-download new candles. I'm just going to quickly go here to Excel. So yes, I didn't generate these date and time stamps. That was already generated from me from the export. Then obviously the open price, I leave it as is. So basically you'll see I put in a random function here. So close is just for interest sake, I got a parameter here that it's 22 because I'm working to 5 digits. It's like 2.2 pips. And not 22. So basically I said the close is the open plus some random between minus 22 to plus 22 to give me a close, and your high is open plus some value from 0 to 22, and my low is open minus 0 to 22. So these are just formulas that I put in here. I also put in some random formula to just give me a volume. I don't know if you need that. But anyway, so one line here in Excel represent one candle, one minute candle. then obviously the important thing is that the open of your next candle here must equal the close of the previous. And then I had the same formulas. You'll also see, for instance, on high, I got a max function here. So if my random close, your close can't be higher than the high. So if the close was higher than the high, then this max will just make sure that the high will become the close. The same here with low. I've built in a min function. So if my random lowness of if the candle is if the close is lower than my low, then obviously the low will become the close. So at line 2, you can basically take these formulas like this, and you double click there. And just to show you in Excel here, I got 1,012,550 candles that I've generated here by copying this down. And in Excel, if you press the F9 key, it will just take a while, but eventually it will recalculate, and each time you press F9 it will generate you a completely new different set. And I've generated many random candles, and I'm telling you, each one is completely different. You can obviously improve my model here. As I say, all my candles, they just updated, so now it ends on 1.6349. But just go here to 1 minute and show these random candles. I'd maybe go to 15 minutes or prove it better. I didn't build in my model that sometimes in the day you get higher peak candles, and then maybe in the morning. As I said, it doesn't matter. You can go do this yourself. So yes, after you've generated this, you will highlight these columns, and you will save it as a CSV file. You'll go back here into your trading platform, and you'll go tools to history center. You'll go to the 1 minute, which should be empty now, and you will go import, and you will basically import your Excel generated 1 minute candles like this. So say you only do the 1 minute, then you make pretty sure that I don't know if sometimes you have to close your Forex and open it again. You make sure you are on the 1 minute that you can see it, and then you click on navigation, and you go to scripts, and MetaTrader has a default script called period converter. You double click it, and it basically will take your current time frame, which should be 1 minute, and you put in a multiplier factor. So obviously if you want 5 minutes, you put in 5, and 64 hour, and a day is 1440, and if you want week candles, it's 10080. I'm not going to do it now. This is for you to do and build your own random model to test my theory here. But basically, people, these candles are completely random. And if you look at it, it's got all the properties of Forex. I was very surprised myself to find this. I didn't expect this. I did this discovery about a week ago, and I did it for myself. I at some point just wondered, how can I know if the Forex is random or not, because no one could give me a fixed answer. I've been searching on the internet, and I just thought to myself that why don't I look at how random candles look like, and if I know, and I was expecting something different. To tell you the truth, I wasn't expecting Forex candles. I wasn't expecting Forex. So basically, this proves to me that the Forex is completely and utterly random, because, as I said, when you looked at this, when you looked at these candles, when I showed it to you just now, you would have not have known that these are random candles. Everyone looking at this clip would have thought this is Forex, and the reason is it's exactly like Forex. I can find no difference between random candles, even if it's 1 million 1 minute candles, and you converted it. I converted it to weekly. It is basically Forex. So what does that mean? To me it means that you cannot predict the future based on past. So all the things that Forex does and that does not seem random are properties of randomness. So randomness would create waves, randomness would create channels within channels, randomness would the Fibonacci would seems to apply it, randomness test previous lows, randomness forms support and resistance. Randomness also, as I showed, I showed those sweet spots, which were the zero lines, whatever. But I'm gonna explain more why I think it works like that, and maybe disprove some, give you more proof that the forex is completely random. So now that I've proven to myself that Forex is completely random, I can now stand back and look at Forex with a completely different perspective. It's actually funny to believe that just because I draw a line here as a support line, and it seems like this green candle bounced it, that I can now make the assumption and say, well, in the next week to come, the market is going to go up because look, it has just bounced on this major support line. So I therefore predict that the market is going to go up. Just to prove how stupid that is, another guy trading on daily might be drawing a trend line from there to there, and might make the prediction, well, the market has closed exactly on this trend line, and therefore we are still in a down move. So for next week, the market is going to go down, and you can see what I mean about different time frames. So it actually sounds silly now to believe that you can draw a line and basically force the market in the next week to come to go in a certain direction just because you draw either a support line or a down line. I mean, currently, yeah, we're basically putting the market in quite a lot of pressure for the next week to come. So because of this line and that line, I have now forced the market for the next week to be between those lines, which is not true. The market is going to wait for the next news event, and it's going to go up or down, and on the news events, not on whatever line you've drawn, or whatever method, or whatever divergence. I mean, yes, divergence again, probably your form of it. The future of Forex is unknown, and you can't base it on a line that you have drawn, or support, or whatever, because someone else is just going to do the opposite on a different time frame. So what I would like to do for a couple of minutes now is disprove a lot of those indicators and things that I've shown you earlier that work so nice, and explain to you a bit better why it seems like the Fibonacci is working. Why does it seem like support and resistance is working, channels, trend lines, whatever. I'm going to start with the most common one, is support and resistance, and just quickly disprove support and resistance completely to you. Okay, I actually went now to a real market. Remember, the euro US dollar is my random data, and yeah, this is the market. I've put the internet on now, so this is the market being downloaded. So we're going to move away. All these other currencies here are actually real data. So I'm on the euro yen here. So okay, let's draw support and resistance. But instead of trying to get it right, I'm going to try to get it wrong. So I'm going to move my line up and down and leave it. Okay, it's completely out. And you can do this right now on your current one. I'm just going to throw lines in here as quickly as possible. And you might think that I'm looking at the market. Go try this yourself. Maybe let's see, is the okay. Sometimes you will find, especially if you start zooming out, that it's already quite hard to actually throw in random support and resistance lines. Even I mean, I've zoomed a bit here. I was trying not to hit previous lows and previous highs, but let's just quickly look at the current time frame. So that random line I've put in there pretty much seems like it hits, the market is hitting it to the pip here. This line here, you know, it might not be exact, but I'll show you later more exact examples. It pretty much seems like the market ranged here between those two lines. If I look at the next line here, it pretty much seems like I've hit a spot there, and it pretty much seems like that's on the pip that I've hit a spot there. This line that I threw in there, it pretty much seems like it hit it there, or it's support or resistance over there. This line here, pretty much there, I've hit it pretty much there. It seems the market. Basically, what I'm trying to show you, go to your Forex now and start throwing in lines randomly. Don't close your eyes and put 5 or 10 lines in. Obviously, you must get a point where the market retraces those lines. So well, let's just go to 4 hours now, and I'll show you something very interesting. Here you can see it much more clearer. Look how this line is exactly so to almost to the pip is a support or resistance for the market. Let's just move a little bit. Maybe I'm moving the wrong side. Let's move this way. Let's look at some more lines here. This line here pretty much looked like those candles closed on the line here. It looked like the market jumped here between them. So if all you need to do is throw in lines, and you will find that your lines pretty much, especially on maybe on other time frames. Let's just go to hourly. It doesn't even matter what time frame you go to. You'll just find that the market just seems to move between your lines and your lines. This is almost like what I shown you earlier. Look here how the market, how these random lines that I put in suddenly seem to have meaning. So basically, take the Forex market, go throw in random lines, and you will find that if you go to other time frames or even in the same time frames, that it seems that your random lines are support and resistance lines. I mean, just look how the market reacted to that. And sometimes you just need to zoom out to see the bigger picture. Look at that. I mean, I didn't try this. I didn't try this. So pretty much it's very hard to draw lines that aren't support and resistance, and all that needs to happen is that the market needs to retrace those points again. Let's just see if I can prove a bottom line here. See if the market goes down. Look at that, people. I randomly put in a support here, and I almost got it to the pip. This line here I randomly threw in, and it basically every line. Basically, my theory now is that if you think about it, in this amount of data that you see underneath it is probably in this amount I would say there's probably 2 million 1 minute candles here. Each candle has a high, has a low, has a open, has a close. So you're sitting with enormous amounts of levels here. So my theory, with so many candles, anything is with so many levels, anything is possible. It is that's very hard to go do that. So go do that yourself, and you will just find that any support or resistance line that you draw, if you go to other time frames, will be a perfect support and resistance. And it seems like the market reacted pretty well on my random lines that I've thrown in. It also seems like it went from line to line. Go test the line here, test the line there, broke the line. Okay, maybe not perfect. Went back to it there, broke it, tested it again, went to the next line, went to the next line, tested the line, tested that line, went up. You see what I'm saying? There's just so many points that any line is a perfect support and resistance line. I just quickly want to show a couple of things about trend lines. The problem with trend lines is most people will draw them afterwards, and your eye will pretty much take the right spot. Something like this, so you'll connect that spot with that spot, and you'll see, well, the market reacted to it so well, and it broke it here. So this is the start of the downtrend, and it tested it again, whatever, and you had a couple of false breaks here. But the problem with trend lines is, as the market was forming, it's not so easy as you think. You would typically connect that spot with that spot, and this will give you a false break. Just go to the next spot. So you'll connect that spot, and that will give you a false break. Or you will be connecting that spot and that spot, and you'll get a false break. There's extreme amount of false breaks of trend lines, and it's only when you look back at history that you know where to draw your trend line. I'm connecting that point with that point, and I'm just connecting this point with a couple. You get a false break. And then finally, you can probably connect that point with that point. You'll get a false break. Finally, you will probably do this or whatever. All I'm saying is it's very easy in history to go draw the right trend line. I'm just quickly going to show you an indicator that I wrote myself to draw trend lines for you. For now, I'm just going to take the default, so it basically draws trend lines for you. But the more interesting about it, currently it's set on Tom de Mark trend lines, which means in an up move it has to connect something with a lower point. It's not allowed to connect like that, or in this downtrend it has to join a point with a higher point. But for the demonstrators, for the purpose that I want to do, I'm gonna put Tom de Mark to false, and maximum trends, I want to see the last 20 trends. And most people say that the period is basically how many candles. So I'm going to put it to 5, which means basically it must find a point where there's 2 lower candles to the left and 2 lower to the right. So if you put it on 5, it will do that for you. And ray, I don't want to see rays. I just want to see the market like that. So this indicator, I'm just showing you how the computer draw that there's a lot more trend lines than you think. And what I should have done is I should have actually shown you the rays. Set the ray to true. All I'm showing you here that there's quite a lot of trend lines, and it seems easy in history to be able to trade them, but in a live forex market, there's a lot of them, and a lot of false breaks. So I just want to show that it's pretty hard to trade trend lines. I quickly want to go to the MACD. For that purpose, I'm going to set this to false. It was one of the reasons why I wrote this indicator. Just going to throw in another indicator that I wrote, my MACD, and this MACD has a feature where it can draw lines for you. I'm also going to set that on 5, the period of how many candles. So we'll basically find 2 to the left, to the right of a candle where there's a low point. Let's do it like that. I've changed the parameter slightly just to show my point here, but basically, as I say, my MACD draw lines for you. So the idea would be this green line here is going down, and where this green line here is going up, and we are in an uptrend here. So the MACD is typically telling you here that watch out, the market is going to go down. But as you can see, that the market just you would probably have sold on that candle because it broke the previous. Look at this, how nicely this looks like. There was support and resistance, and the candle broke it. You had everything. You had the market going up, you had your MACD going down, and you would have sold there, and yet the market decided to go on. All I briefly wanted to show, if you really carefully look at MACDs, you will find there's probably more places where it doesn't work than it works. Probably in a long uptrend, you will find a lot of divergence, and divergence just does not work. You can't really make money on it. This you'll have to find out yourself, but I was just showing you one example, and there's hundreds of it. If you start looking closely, you'll see there's a lot of times where divergence will fail you. Not to mention now support and resistance will fail you probably more times than it will help you. I just quickly want to go back to sweet spots. All I want to try to show you here that I've set sweet spot where it normally goes to 0, I've set funny pair. So if it's 15 minutes candles, then it should go every 1, 4, 2. If it's an hour, then it's 3, 8, 9. So I'm taking numbers that I could just think of. If it's 2 hours to 40 minutes, then it should draw as a line every 866 pips. And I'm just showing you, if it's a day, then every 2, 3, 4, 5 pips, and so on. So I've tried to take the sweet spot to take the human element out of. So I've basically reprogrammed this indicator. So I also went to the Great British Pound here, so that you know that something may be more familiar. So I'm just showing you sweet spots here. At the moment we're looking at weekly. So if you look at the values of the sweet spot now, it doesn't really make a lot of sense. It's like 1.66614. So that's that line. And when you look at it, let's just zoom again. So basically, sorry. So basically now my sweet spots shouldn't have any meaning. So I've chosen non-zero line. So I'm looking at the weekly. And let's just quickly look. You'll find a lot of times that it seems it tested the sweet spot, it broke the sweet spot, it tested the sweet spot, went back to the sweet spot, jumped between the sweet spots, broke the sweet spot, went to the next sweet spot, jumped between them a couple of times, broke it, okay, went exactly to that sweet spot. It's not always exact, but you'll see it came down here, tested the sweet spot, tested that sweet spot, tested the sweet spot, and at the moment these lines are like 194,195, and this line is 1.89194. So basically, you will see it's testing sweet spots, working from sweet spot to sweet spot. Let's go to the daily and just see if we can see the same. If you zoom a little bit out. What are these numbers now? This is the pound, so I got yeah, some of them are like 25 and 80, so maybe on 15 minutes but still, whatever you draw, this also is another proof of support and resistance. I mean, instead of you randomly throwing support and resistance lines in, I'm just showing you that basically every line in Forex means something. So this line, it hits it. Okay, there, maybe not quite, but let's just see. You will a lot of times find that it just seems like the candles. You draw two lines, and it will just seems like the candles run between them. Here it went back to the sweet spot, broke the sweet spot, went to the sweet spot, tested the sweet spot, back to the sweet spot, broke the sweet spot, went to that line, went back to this. And as I say, the sweet spot should not have such meaning now as before. Went to the sweet spot, back to the sweet spot. So I can go to any time frame. Let's look at these values now. 1.56746, that line there, and it just seems like it broke the sweet spot. All these candles tested that sweet spot, finally broke it, went back exactly to the sweet spot, which is now 1.58455. Tested the sweet spot, back to sweet spot, back to sweet spot. So basically I'm saying in Forex, if you just draw a lot of lines in it, if it's random or not random, if it ends with zero or not with zero, the Forex has so many points that it doesn't matter what you draw, and go test it. You will find that sort of the market goes between them. Let's just go to 15 minutes. Oops, don't know what happened there. Didn't draw it. Maybe there's something wrong with the indicator. Okay, even on 5 minutes here, as I say, these are real Forex data. So, I don't know if the 1.61028 has significant meaning. Oh, it's pretty close on, or the 60886 line here. Let's just see what happens to this line. You'll see it get tested 100% a couple of times. It does seem like the 1.60886 line in the pound has significant meaning. It. But that's basically my point. You can basically draw any two lines in any time frame, or 1.61169. It just seems like the lines are tested, that it runs between two lines, sweet spots. So basically, this is just another proof. If you believed in support and resistance, all I'm trying to show you here. Oh, there, the 15 minutes now worked. Don't know what happened to it before, but if you really believe in support and resistance, this is a very good indication to you that almost any line forms a support and resistance. I mean, look at how it jumped to almost to the pip, tested it, went up. You can, I mean, look here. So this is 1.62306. As I said, it doesn't matter what your line is. You will find that with so many candles, with so many levels, that it just seems like the Forex is reacting to it. If you look closely, you will just see it. So as I say, sweet spots is just another form of support and resistance. So I'm very sorry for you if you really believe that your support lines has any meaning to it. It has no meaning to it. If you really believe that the human element of round numbers or every 100 pips means something, and that the market reacts to it because it seems like it did, it doesn't mean anything. It is just there's so many lines, there's so many candles, there's so many points. Basically, any line has meaning. Well, I think lastly, I'm just gonna show you the Fibonacci lines, and it's the same principle that I've shown you. You believe that the Fibonacci is special, that it's got a special ratio. So in this down move here, you could easily draw your Fibonacci lines here. And now let's look at the future, and then you show me, wow, look how it broke the Fibonacci, the 100 Fibonacci, and how it exactly went to the 161.8 here. It's just amazing. And look how the market retraced at 161.8. And let's show you something more amazing here. Oh yes, look at that. 261.8. Look how the market 100% responded to it. So remember, we're not on random candles here, we're on real Forex. But as I shown you, this is my random candles. It doesn't matter where you draw Fibonacci. I've just shown that any line has meaning. So I will prove that to you now with a Fibonacci. So we've just proven that. I mean, this is typically this is very amazing. But I'm still saying that you can't really trade on it. So I'm going to change the Fibonacci lines now to whatever I think, to anything, random numbers. Okay, so I've just changed the Fibonacci, and please believe me, I haven't worked this out before. So let's choose 30, 66, 1, 1.4, 1.8, 2.25, 2.8, and 3.10. So let's press OK here and see what it does. So yes, whatever my 66 line here pretty much looks like the market tested. It's pretty much okay. Obviously, it went to the 100 there, but it did test this 66 here. Okay, the 140 in this case didn't work out so well, but there it pretty much tested my 180 to the pip, and then it broke it, and then look, it went exactly here to the 225. So it also, if it breaks my 180, it goes to the next one. Look how it came back to my 180. So obviously my 180 line that I randomly just chose now has some significant meaning. And yes, okay, I missed that nice one spot there, but it doesn't matter. Look, the market came back to my 180 line. It tested my there my 140 didn't mean much, but I mean it did. I mean look at that bounce there. But look here, with this move back now, suddenly my 140 line does have meaning. You see what I'm saying? There's nothing special about the Fibonacci. You can go put it anywhere. You can even draw it in places where you shouldn't. I would like to connect it to that green candle there. And this is not this is not even Fibonacci. Okay, obviously, well, my 100 line there worked out very nice. I mean, that is not a high or a low, so you wouldn't expect. I mean, normally you connect it there. I've done something that you shouldn't do. This is not how Fibonacci work. You don't connect it there. Yet, look how perfectly my 100 line worked out. Look, this 66 line, you had a bounce there. Obviously, that one will bounce at the zero. 140. It's pity the market hasn't come back again. But look again, I've connected different place now. Suddenly my 180 line still has meaning. My 280 line there still has meaning. My 310 that I randomly decided on still has meaning. Look how it broke it. Look how it bounced against it. Look how it broke it back. So look how it went from my 310 to the 280. People, there's nothing special about Fibonacci. Maybe it works. Yes, I mean, apparently special ratios, but not in the Forex market. Any line is special. Look how special my 310 is, you know. I could say it bounced there against a 225. It went back at the moment exactly to the 180. And so you can go on. You can you can put this Fibonacci thing. Obviously I want to go a bit further back that I have more detail. Let's do something odd. I don't know what. How does it work? It's connected to that red candle there, something like that. How about that one? Okay, I haven't seen how it looks like. Hopefully the market will go up to it. But yes, my zero line here shouldn't have meaning, yet it bounced against it there. My 66 line shouldn't have meaning, yet it works there. So I've put the Fibonacci how I think it should not be put, and yet it has meaning. Okay, well, even here the market seems to bounce against it. You might say it's not working perfectly, yeah, but yet, I mean, the theory is once it's broke a Fibonacci line, it goes to the next one, and that principle is still, it might have broken it back, but it was broken, and now it goes to my 140 line, which which have no meaning. It breaks it, and now it gets to my 180, pretty much bounce against it. And yeah, okay, this time the 225, it's not perfect, but it's you know, if it was a real Fibonacci, you would accept that it actually went to it, and it came back here and it tested the 180 around here. It broke the 180, and look, my 140 has meaning, and look, my 100 line even here has meaning, even though my 100 isn't at a high or a low like it typically should be. So the 100 line should have, as I said, the 100 line here didn't mean much, but look at this to the pip. So I'm just proving to you guys that lines, Fibonacci in Forex means nothing. And I mean, I didn't even go to another time frame. If you start going to another time frame, you will find that those lines has meaning in all time frames. You know, I mean, look how it bounced here between the. Let's just see here. I need some more candles, but this 140 line, you know, several times it tested it, broke it, it came back. You know, I'm pretty sure. But anyway, I'm just showing you. That support and resistance means nothing, Fibonacci means nothing, trend lines means nothing, divergence means nothing. I don't care what special indicator you have and what special number you came up with, and it has no meaning. I mean, do you want to look at moving averages? 20. 20 is one of the best moving averages because it's the middle line of the simple 20 moving. Let me see if I'm on simple here. Yes, it seemed to have extreme significance because it's the middle of the Bollinger. So I always thought that everyone is using the Bollinger line, and that's why the 20 has meaning. Yeah, you just saw now that, I mean, yes, last night I tried 66, so I'm going to try 66 now. Just that was on a completely different currency. So it seems like the market bounced against the 66. It came back to the pip there. The same applies for moving averages. The market will bounce against it. You know, it's just a matter of there's so many places, there's so many points that it has to have some significance, and then it doesn't matter what timeline you go to, you will find that whatever line you put in there has significance. I mean, why don't we put in the numbers that like 100 that all the Forex companies and all the trainers are telling you are special, and let's just see. Obviously the 100 is special, just like any other number. Somewhere it has to bounce against it. Well, I must say in this case the 100. Yeah, as I say, it has to bounce. It has to jump on it somewhere. There's just so many points. Well, let's look at the 200. I think that's another special line, especially on the daily. Yes, so if you look at the 200 line, you would see, you know, a lot of times they would say, oh, the market went up here because the 200 line formed some resistance. People, it didn't. It's just so many points. At some point, the 200 line has to be touched. Like here, it seems special, but there's nothing special about it. That's why I'm saying you can put any line in there. For instance, 1, 2, 3, which I've never tested before. So yes, I can also say my 123 is special. Look how it drove the market down, yeah, and it tested it again. It broke it. It tested it again. So this is my 123 line. I think it's a pretty special line. So yes, what is your special number that give you the advantage in Forex? I at the moment don't think there is any special line, any special number, and any special indicator. Maybe I just want to sign off here, or finish off with with another thing that I realized. You can never change the odds of Forex. So a lot of people will start combining indicators. I don't care if you have 10 indicators that are in sync. You are not changing your odds. You are just changing the frequency at which you trade. You cannot change odds of randomness. It's not even if all 10 your indicators show that the market should go up. You've just changed the frequency of trading, not the odds. So I would like to quickly talk about candle patterns. Before I mentioned that a lot of people trade by them and they believe in it, and that, as I said, that's normally they look at, they say there's a candle pattern that normally is a reversal of a trend, or that you get at the beginning or at the end of a new move. So I've quickly programmed here the engulfing one, the inside bar, the piercing, the dark cloud cover, and the 3-bar reversal. These are just 4 candle patterns for up and 4 for down, if you take the inverse of it. So, but the problem is, once you ask a computer to put it on for you, you'll see a different story. You will realize there's much more candles or candle patterns than you would have thought. So what basically it means, whenever you see a green arrow at the bottom of a candle, that means this one is identified as one of those 4 candle patterns, and obviously a red one above means that this candle is one of those 4 candle patterns. And as I say, people who trade, they don't see how many there really are. They only see what they want to see. So it's my belief that the moment you have candles next to each other, or a few candles, it will form candle patterns. And in reality, there is much more than you see, or that you want to see. So normally you would typically only see that one that started the uptrend, but you will ignore that one that showed down, or maybe that one. So when you are trading, and that's the big problem with people who are trading Forex, they look at patterns and the eye is trained to see only the good ones. You don't see all the false ones in between. And the moment you put it in a robot, and people can't believe that candle patterns doesn't work in a robot until you show them. I would just like to show another set of random candles that I've created in Excel. This one is a little bit more unique, and you will understand when I go to the 1 minute. This is what I've generated. I've basically simulated the simplest form of randomness that you can get, which I believe is the flipping of a coin. So you can either get head or tails, and each one is of equal length. In this case, I made each candle one pip. In this case it's 10, but it's actually just 1 pip. So this is typically the pattern that you will get if you start flipping a coin. And if you really don't know how to use Excel, you can flip it a million times, but this is basically what you will get. What I was surprised about coin flipping is the amount of trends that it does seem to form. I've heard before that people say, yes, the Forex market trends more than most of the time, and well, it seems to be true with even the most basic form. But believe me, I've tried many strategies where I've tried to make profit out of this trends. But if you look at this, and as I say again, the same principle applies. Your eye ignores, when you look at it, all you see is the trend, but you don't realize how many pips are in these ups and downs, and at the end of the day, that you can't really, or I was unable to create a robot that seems to work when it comes to these trends, because of this, or because of this. So yes, obviously at the end of the day, for me, Forex is nothing than the flipping of a coin, which will generate you random candles. And yes, Forex doesn't look like this on the smaller time frames, but if you start going to 15 minutes, you will see that these flipping a coin is exactly what Forex is. There's no difference that it forms all the principles that you get in Forex. And I mean, if I go here to the daily, as I say, these are still those coin flipping candles that I've generated, just looking them at a daily instead of 1 minute. And if you want to see the whole set, this is how the whole set looks like. I just wanted to show you one more interesting. The other day, my son was looking over my shoulder while I was looking at this, and he says, "Dad, this looks like a mountain." And I said, "Yes, it does look like a mountain." So I decided to download silhouettes of mountains and start looking at it. And just like mountains are random, they are very, very similar to Forex. So I took one or the second picture that I could get, and you're obviously looking for one where there's a lot of hills and valleys and so on. So all I did, what I'm going to do now is I just went to, I'm going to stretch it a little bit so we can see the ups and downs more clearly. And I'm going to just, unfortunately, I only have paint here, so I'm just going to use paint, and I'm going to show you how mountains and Forex correspond or very much the same. So I'm pretty sure you can draw some trend line, maybe like that, and it seems like the mountain tested the trend line, it broke the trend line, and then it changed direction. You can maybe draw a channel, something like that. You can draw another trend line here, maybe something like that, and then you can say, well, the mountain broke the trend line there and it started the uptrend, just like in Forex. But I think more interest that I wanted to show is if you start connecting. Let's just draw horizontal lines, and yeah, you might need to move it a little bit, but it does seem like it tests previous highs and previous lows. Let's just take another one here and see if there's any correlation. Yeah, it seems like that one almost tested there, and it almost seems like this bit here corresponded to the line there. Let's just go some more and see what we can find. Yes, it seems like that high there was tested by that one there. Let's draw another line. So this is typical, just like Forex and mountains are nothing different. So here's this is a good example. You got that high there. It came there, it tested the high there again. It came back, it tested that line again, and then the mountain broke the line and it retested it there. So yes, I don't see any difference between the lines the horizontal lines you draw in Forex and lines that you can typically draw on a mountain. There, that peak was tested there again, and maybe there again, and almost there again. And so you can go on. So basically, yes, if you look at Forex, and it doesn't matter what time frame, it pretty much looks like mountains, and it has pretty much the same principles as mountains, or pictures of mountains. So yes, if you don't believe me, go get a couple of pictures of mountains. Just make sure you have one with a lot of hills and valleys, and you will find that the mountains does the same. Unfortunately, I wish I could make this the background of my trading platform, so that I could look at Fibonacci's. And yes, the Fibonacci's will work on ranges, as I've proven earlier, that almost any line, any number, if you got enough hills and valleys, you will just see that it starts working out. So yeah, maybe I've mentioned this before, but just very, very quickly, as I say, the reason why I believe Forex is so random is the amount of data releases or news events per week. There's just so many news events per day, and each one of them can drive the market up or down, or give it a spike, And as I said, and the other reason is some people are trading maybe on a lot of trading on 5 minutes, and whatever they see as up, someone else is trading on an hour and they might see it as down. So combining all the time frames, combining all the news events basically forces Forex to be pretty much random. I would like to give my opinion about people that can show you Forex trading accounts where they've done extremely well, and then they say that Forex isn't random because they can actually show you trading accounts that are well. This account here is account from my father-in-law. He's probably the best scalper that I've ever seen. And if you look at this, you will see he started here with a deposit of $100, and all this is trading in one day, and he managed to make $63. So basically, he managed to make 63% profit in one day. I don't think he opened multiple orders at a time, and all the orders were the same lots. So this is quite an amazing trade that is done here. Um, he's also managed to do this like 3 days in a row. The next day he did like around 50%, and I think the third day he did around 40%. So this is amazing trading, but according to me, this type of profit can't be kept up on the long run. I believe there's many techniques that can be used in Forex to give you the illusion that you are that you've changed the odds, and that you are making a profit. One such technique, which is not necessarily being used here, but a technique would be to take a small profit, because you might take 100 pips loss, but only try to make a 5 pip profit. I've also seen my father-in-law previous year did about 163 trades, I believe, of which only one was a loss. So yes, it's a significant technique, but at the end of the day, please note that this is a demo account, so it doesn't have the same um, profits on live accounts. But yes, if anyone is interested in his technique, I might ask him to make a video clip, and maybe he will sell it at some price or whatever. But up to now, he's only been making money in a demo account and not on live. Now, I believe there's a big difference between a demo and a live. So the moment someone shows you a demo account, the execution of, I can make a whole video clip why the execution of a demo account is completely different from that of a live account. I believe it's much easier actually taking your profit in a demo account. The biggest difference is when you buy or when you sell, there's a robot on a demo account that will will open your order or close your order at current market price. So it doesn't have to be filled by a real a trade. And believe me or not, you might not believe me, you would think that demo and real trading is very much the same. It's not. There's a big execution problem. The other problem that you might get is on a demo account, as I say, the order will be taken. On a live account, it might say requote, and by the time you get your order open or closed, the market has moved. So please keep that in account when you see a demo account. But even if someone can show you on a live account, I don't believe these profits are sustainable over a very long period of time. So even after my father-in-law showed his technique to me, I was unable to reproduce it in a bot. I believe there's a lot of things that he does that happened with experience that you just can't put into a bot. But anyway, it did make me think. Basically, I've waited now till January month, because I did my own investigation. I started looking at random candles again. I did some analyst here, so in column H here, I put a 1 every time there's a green candle, and a 0 and a 1 in column I if it's red. And then I look at statistical wise, a good randomizer should have almost the same amount of red candles versus green. So this here is a percentage. I got 50.03% green candles and 49.97 red candles. And this so I tried a different technique where basically I tried to buy a relatively low and sell relatively high. I also build a robot where I open multiple orders and waiting till the market gets in your favor and then close all the orders. So after a long a couple of days programming again and testing and retesting, I managed to come up with a robot that basically traded on these random candles, and this is sort of how it looks like. In this data set, I actually started in 2013 from to 2014 on my random candles. So basically, I traded random candles, those 1 minute candles, but only for 2 years instead of the 3 years. It was just to make things a bit faster. And I thought, yeah, at this point, sure, I've produced something amazing. It seems like if I can get a graph like this on 2 years of trading, and I managed to take basically $5,000 and convert it to 7,000, that is very good. Here you can see the statistics of my trading. I had a relative drawdown of say almost 14%, and I converted 5,000 to almost 2,000 extra. I mean, compared to what my father-in-law did, this is really crap, but it's the best that I could do. And I thought maybe I've proven something to myself. Maybe it is possible to be able to trade on randomness. So to test it again is I generated a new set of, so I went back to Excel here, I pressed F9, I generated another million random candles, and I also put it on real. I took the same robot that I've generated on randomness. I put it on real Forex data. So what I'm going to show you now is the result of how this same robot did against real currency. And this is the graph, and it's a very interesting graph, and I believe this is the graph that shows you and explains to you exactly what happens to a lot of Forex traders, and especially people that can show you profit accounts. This period here is at least 3 years of trading. So an uptrend like this is almost for 6 months. It seems like at this point here you would believe that this is the ultimate robot, and that nothing can stop it. So you're doing very, very well for 6 months, and you suddenly have this big dip, and then again doing well and having a dip. Now I believe this is a typical graph that you can get in Forex using various techniques, and I've actually seen a lot of robots and I believe a lot of people's trading that are successful are basically represented in this graph. So all they are showing you a period where they are doing well, but if they keep on going, because you are reinvesting your money and reinvesting it, at some point you're going to get something like this. But if you keep on trading forever, I'm pretty sure you're going to end up something like that. So if someone shows you again a positive trading account, first of all, make sure it's not a demo account, it's a real account. And I would say yes, if someone can show you a positive trend over 5 years, then that person got something. But then I'm going to tell you, it's most likely 1 out of a million, and but the chance for you doing that is 1 in a million. It's just not going to happen. I mean, just ask yourself, why is someone selling you a trading method or want you to follow him at some price if he's not successful himself? The reason is that most likely the person discovered that he actually can't make money over the long run, and that the best way is to actually sell something to you. I mean, for a person to be, I must just say, most people can't even produce a graph like this. This is actually quite an amazing graph. You will find that most beginners just have a graph that are just going down all the way, and most traders lose. So even after many years of experience, and trading, people might be able to produce something like this. But if they do it forever and reinvesting their money, you're surely going to get a drop, or the market is going to be unexpected, something unexpected happen, and the market just drops. I just went back to this graph. The other reason why someone are selling a trading course to you, or a teaching thing, or follow me, or is a so-called guru, even the best in Forex, you might find that the amount of money that he makes in a long period is actually quite small. If you look at this again, I mean to invest 5,000 and only make $2,000 in 2 years' time. In Forex terms, it is extremely low. And the problem is the leverage. It takes 2 years to make a little bit, but within 1 week or within 1 day, you could potentially lose all your money, or you could just hit a bad streak. So in this case, this particular trading here is quite bad. So I believe a lot of forex gurus who are so-called gurus, they're either just deceiving you, or they have produced a uptrend that are so significantly low. Or even robots that people are selling, they're making such a little amount of money out of it that it's more beneficial for them to sell something to us than to trade themselves. So since I've now proven to you that Forex is nothing more than a coin flipping randomly, I just want to warn against binary options. You have absolutely no chance. You got a much worse percentage if you think you can trade binary options. I mean, I've proven now that Forex is random. So normally with binary options, if you win, you get like 80%, but if you lose, you lose 100%. So immediately you got like a 20% disadvantage. So in my eyes, binary options is nowadays, I've seen it's a big thing. That people are saying it's easier. They are just trying to get the people that aren't so technical. They make it easy, but they just have an option for you to lose more money at a quicker rate, much quicker rate than Forex. So I just want to give a strong warning here against binary options. You have no chance, especially now that you know that Forex is random, and you only get 80% back. So you have a 20% against you on a purely random outcome. I would like to end this video clip with what I read Warren Buffett apparently said. And basically, first of all, I don't believe he ever traded Forex. I believed he made his money out of shares and companies and things like that. But the important thing that I believe he said was that the time that you buy a company is not important. It is the company that you buy, not when you buy it. So basically, at some point he said, if you zoom in and you look at graphs, it doesn't really matter when you buy it. It's important that you invest in a good company with a good product that are sustainable for the future. Now the problem with Forex is, with Forex, because of the leverage, you are immediately linked to time. So in Forex, time is everything, because you can't wait out a dip. Because of leverage, as the market are going down, it is pulling your money out of your account, and at this place, at a certain place where your money is zero, it will close your account. So when the market goes up again, it doesn't matter, your account has already been closed at the lowest. So Forex is linked to time, and where normal share trading is not linked to time. You can basically, I believe my robot that I've written for Forex will actually work pretty well on shares, because basically you buy the dips, and that Forex you are linked to time, and I believe therefore shares will do better. So just remember this graph. If you think you're a good trader and doing successful, I can almost guarantee you that this, over a long period of trading, even if you're very good, that this is the type of graph that you will end up with. I would just like to show another graph that could typically show what can happen to Forex traders. If you are extremely well, you might be able to produce a graph like that, but I believe if you keep on indefinitely trading, this is typically what will happen to you. Just some very interesting fact or statistics on my Excel sheet here. I've um, I've I've looked at what is the maximum amount of consecutive heads or consecutive tails that was generated by this random set of data, and it turned out to be 22 times. So basically, if you play over, if you take a coin and you flip it like a million times, there's a good chance that you might hit heads 22 times in a row before it changed to tails, or the other way around. And maybe in your strategy, when that happens, you will typically this drop. Not even that it has to be close to 22 in this case. This is just a graph of a typical very good robot that I found. And but after trading for some time, this is what it did. I can just show you this graph as well. Was one of my robots that I wrote. I achieved this by actually using the optimizer in MetaTrader. So just be careful when you optimize things. I mean, this robot here has produced 2,475 trades, and it was still successful. But the moment I gave it new data that it's never seen before, or you put it live, it very much, unfortunately I don't have a picture of it, but this is sort of the thing that it did. It also started making money for some time, and then suddenly took a nosedive. So even if someone can show you that a robot or a trader have success on the past, it doesn't mean that success will continue in the future. And maybe I also want to show you this graph. This is another robot that I wrote. This at some point I believe the answer to Forex is to only trade on day candles. So this robot was a period of 10 years, and although this looks like it flatline, it's just that this growth is so significant that it looks like flatline now. Basically, if I go here to the statistics, I started off here with initial deposit of 10,000 Rand, and this robot managed to convert it to 370 million in 10 years time. So I can also thus show you a robot that has tremendous growth, this robot is completely unreliable and will never work on live trading. The big reason the relative drawdown was 97%. So the moment you put this live, it will just most likely take a nosedive immediately. But this was done by optimization again. So I just wanted to show you what is possible to do with optimization. So don't, if someone shows you a robot or a trading method where you can convert small amounts to big amounts, somehow our people like to hear big amounts, so they like the fact that I say I've got a robot that can take 10,000 and convert it to 370 million in dollars in 10 years. And but don't fall for the trick. It's most likely something to do with optimization, and when you go for it live, it will most definitely fail. Maybe the biggest proof of everything to show that Forex is random or that it doesn't work is to look at your own account. As I say, you most likely will definitely not have a graph like this. You will just see that it just goes down. So my question to you is, how many years are you going to spend wasting your time and money trying to make money in Forex before you come to the same conclusion that I've come to? I've basically spent 8 years of my life, and I didn't just lose the money in Forex and the time. I also lost, I could have done much better things, maybe much better in investments. So basically I've put my future in a position where I'm probably much worse off now than just because of the decisions that I made in my life. So my question to you is, how many years are you gonna do the same as me? And hopefully this video will wake you up, that you can see what is really happening there, and that you don't waste as much time as me. So yeah, this is from Richard Rousseau. Thanks for watching this. As I say, if you got any statistics to show me, please email me, or post something on YouTube. Prove me wrong if you can prove me wrong. Maybe there's people from that works for Forex companies. Maybe we can get real statistics of how many people are actually making it in Forex, let's say after 5 years. I will be very interesting to get those statistics. Mostly when you read about Forex, people are saying that 90% of people don't make it and that 10% makes it. But I believe those statistics are completely skew. I believe the true statistics might be more closer to one in a million, or maybe one in a thousand. So basically, you have no chance. So if there's anyone there with statistics from trading companies, it would be interesting to get some of those statistics out. So let's see what is the real statistic, because I always thought that the 10% is not so bad. I thought if I keep on another year, learn more, try harder, read more, learn to control my emotions, like everyone say you're an emotional trader, that I will get to that point where this won't happen to me, because you just started successfully and then suddenly this, and then you look at your trading, you see, oh no, I made this mistake, and you adjust some parameters, or you adjust something and you try again. But at the end of the day, one rule is for me very, very sure about Forex. It will always end up in you losing all your money in your account. So prove me wrong, show me some statistics, and let's hear from other people what they have to say. So thanks for listening to this clip from me, Richard Rousseau. Cheers.